Hello, everybody, and welcome to our first Views That You Can Use. This is the first one for November 2022. As you can see, this is the graphics from our website, binbrookfinance.com. If you haven't visited, I hope you visit it shortly. So let's get started. And what I wanted to say about this is please provide any feedback or input that you have as to what you thought of the presentation today, whether it helped you out or not. And also, one of the reasons that I want to do this, I know some of you tell me, Brett, I rely on you to know this and make decisions, but I also like to educate people and help them along as well. So economic data highlights. Just this past month, the Bank of Canada raised rates 50 basis points. It appears that they might be slowing their raises, but they've still gone from 0.25 to 3.75 in this year, and that is the fastest tightening of monetary policy over such a short span. The Bank of Canada expects a tougher year economically in 2023, and they expect a significant slowdown somewhere. According to their forecasts, inflation, they hope, will drop below 3% in the fourth quarter. That's about when they probably might start reducing interest rates, but we'll see. Tiff Macklem, the governor of the Bank of Canada, was saying in interviews last month that they do expect a significant slowdown in 2023, not a big recession, but still a slowdown. We're of the opinion that we can see a recession, and certainly there's many reasons to believe that. Bank of Canada expects 70% odds. I'd say it's closer to 100 myself. In the United States, the Fed raised rates by 75 basis points, or 0.75% on November 2nd. So they're up 3.75% this year, which is quite a bit. And what the markets were looking for was some type of signal that the Fed was close to pivoting on continuously raising rates very high. And Chairman Powell certainly put stops to that very quickly, and said that they don't expect to have a lesser rise in rates at the next call unless inflation dropped quite a bit by then, which doesn't appear to be likely. So we're looking at probably another 75 basis point hike in the States come December. And he also said that the terminal rate, and that's the highest the interest rates will go, is expected to be a little higher than a lot of markets were pricing it at that point in time. It kind of appears as though the maximum rate will be about 5% in the States. I don't think Canada will get that high personally, but it's going to be darn close, like 4.75. So we might have another percent to go in Canada on rate hikes. One of the things we need to keep in mind is we've learned a long time, don't fight the Fed. And mostly what that comes to mean is that when the Fed is reducing rates, the stock market's going to be held up. And that seems to be one of the major reasons that they've done this, is to keep the economy moving and to keep stock markets going, because somehow economic success and politics in the States equated it to that, which is quite silly. But the returns last month, the stock markets were up quite a bit. Anywhere from, say, 5% in Canada, the Dow Jones up 13, and the broader market, the S&P 500 up 7. The bond markets were down a little bit, but more importantly, the markets have been down this year about 11, 12% in the States, 13% globally, and about 11, 12% on the bond market, and 6% in Canada. What we've seen very often in the past, as we see these good returns, is that we get bear market rallies. These aren't signals that the bull market is here to stay again. These are very common. And in fact, 16 of the top 20 returning days on the stock market of all time were in the middle of bear markets. So we're in the middle of losing money long term, but they have some of the best rallies in the meantime. What we're going to talk about next is just a couple of ways to measure the stock market, how expensive it is compared to the past, where it is right now, and what we should expect going forward. So this is the Shiller Price Earnings Index. It goes back a long ways, and it compares the price of a stock or the stock market, and it divides it by the earnings of that stock or the stock market. And we can use that to compare companies to each other, which one's more expensive than the other, and which one makes sense over a longer period of time. Is it more expensive compared to what it was in the past? Is the stock market more expensive compared to what it was in the past? And we can see with the graph here front and center, the long-term average of this is about 16 to 17. So that's kind of where you would see the average price earnings long-term. Anything over 17 would be considered somewhat pricey, and over 25 is extremely pricey. Right now we're at 28.51. And if you look at this graph, there's only been a few times where the measurement has been over 25, and that's Black Tuesday at the end of the 1920s. That was with the dot-com bubble burst, and we didn't even get there in 2008. And then as recently as now, we were at 44, which is second highest of all time. Right now we're at 28.51. So when you have that into context, that's nearly double the long-term average. And when we look at where markets have bottomed in the 20s and the 30s and the 80s, even in 2008, we see that we're much higher than any normal value when bear markets ended. And what we also have to keep into consideration is when bear markets have ended in the past, what we've had is a situation where governments have been trying very hard to stimulate the economy, dropping interest rates 2, 3, 4, 5%, increasing money supply. And right now we're doing the exact opposite. So the expectation that the market should go up and these values should increase, I think is completely unfounded at this point in time. One other way, not as important in my mind, but it's a good way to look at the markets is price to sales, just to look at things and see, is the sales of the market out there, sales of companies above average for what you have to pay for that stock or the stock market, or is it below average? Are things expensive? And we can see the median long term in the graph on the left is 9.9. We're at 2.33 right now, as you can see on the graph at the right. So we're over double, again, what long-term valuations say stocks should be. I know everybody's interested in housing, so we're going to talk about housing for just a second. RBC has a great economics department and some great research on housing prices and where they are. They've created this affordability index, which you can see on the left, which tells us how housing is as far as expenses. Is it more expensive in the past? And they don't just look at raw prices of housing. They took a look at the affordability. So what the affordability includes is interest rates you pay on your mortgage, the price to have the utilities in your house, the natural gas, the electric, whatever utilities you might have. It's basically an average basket, as well as the housing price itself. So we can see that as of recently, we're at the most expensive of all time. And while it's okay to have houses that are expensive, if you can afford them because the interest rates are so low, and it's okay in the past to have interest rates relatively high, like they were, in the 90s or even in the 80s, as long as, the price of housing is cheap, but you can't have both expensive houses and high interest rates because negative things happen. And we take a look back, and this peaked in 1989 last, and housing prices went down 35% to 40% in the GTA. Some areas went down as far as 55 and 60% in Toronto area. And so it's kind of expected the same thing's going to happen here. And so far we're down nearly 16 to 18 to 20% from the peak prices, and sales are down 44%. RBC expects in the future that this graph, as you can see on the left, is going to come down. So certainly I think housing is going to continue to be under pressure, and it's going to be a serious issue economically. And I thought this would be of interest to people, pardon the pun, but just to take a look at where rates are going and have gone. Mortgage rates over the short term are 5.99% over 1 year and 5.49 over 5 years. And we can see that this is kind of an inverted situation where the rates over the low term are not much, but they're higher than the longer term. And this is part of an inverted yield curve that often, 100% of the time actually, predicts a recession into the future. GIC rates, on the other hand, are at some of the highest rates we've seen in a long time. And like we said, we expect these rates to go up anywhere from 0.75% to 1.25%. So we could be faced with mortgages as high as 7.25% before too long. We need to plan for these things. And I want to show this slide every month and talk about how we can help other people. And one of the things I think we have a responsibility to do is to help the future generations and their fiscal knowledge. And basically what I mean by this, it is expensive to buy a house. We do need to plan for this. Interest rates are high right now. We've got a lot of inflation. So whether they're our children or our grandchildren or younger people we know, we should help them just learn what they need to do to plan to have a successful future. And I've done that for a lot of my clients, kids and grandkids, whether it's setting up accounts for them or just talking with them and showing them the right direction to take. And I'd be happy to help other people do that too, because I think it is our responsibility to help the next generations have financial success as well. This is an interesting one. We're going to talk every month about a green story. And sometimes that's going to be a story about a stock that is just an interesting stock. I might not recommend it, but I just think it's interesting. Or it might be something, a good story. Many of you know I volunteer at the Binbrook Conservation Area and the Binbrook Conservation Area with the Binbrook Conservation Committee. And over the last 2 years, we planted 3,500 trees and 3,500 shrubs. I'm fully committed to doing things around here that I think will help the environment. This month, though, we're going to talk about two stories. We're going to talk about the Canada Greener Homes Initiative, and that's something that can help you and help you reduce your cost in your house. So with the Canada Greens Initiative, combined with Enbridge stepping up for this, you can get up to $10,000 in rebates in order to improve your home. Now, if you're interested in finding out more, I'd be happy to address any questions you have about it and provide you the links to go to the site. You need an auditor to come in and check out, see where you might need the improvements the most. Maybe your ceiling, your attic needs more insulation, and you can get up to $1,800 back to fix that. It's a great program, and it can greatly reduce your cost to fix up your house and make it more efficient, which will reduce your cost in the long term. The other thing I wanted to talk about, not to get too political, is Bill 23 that's been proposed by the Ontario government. And Bill 23 is structured at improving the housing situation in Ontario, which we all know we drastically need. There's just not enough housing supply right now. I think it goes in the wrong direction, and unfortunately attacks the conservation authorities in the province. It attacks the green space that we have in the province, and these green spaces are already being declared that they can be developed. And we declared this green space for a reason, to protect our environment, to make the region more livable, and to reduce flooding situations. And this is going to put a lot of that in danger. And what I want to read to you is just what the City of Ottawa had to say about this. The City of Ottawa Planning Department. They said Bill 23 narrows the housing discussion to one of quantity, diminishes the roles of the municipalities and the conservation authorities that they play in providing quality and support for growth. They expect revenue shortfalls, the City of Ottawa do, more money demanded from taxpayers, which means your taxes are going to go up to pay for all the infrastructure for these places. They expect an erosion of the quality of life and of the natural environment. Personally, I don't think this is a good thing, but you can judge for yourself and maybe speak to your MPP if you think it's a big issue. So we've reached the conclusion of the talk today. Please visit my website if you haven't already, binbrookfinance.com. It's got a lot of great information. We've been working very hard to provide more services and improve what we do for you, and a lot of information there on that. I update Twitter as often as I can with timely economic and market news for you. LinkedIn has quite a bit of information as well, so please visit those. Additionally, please share this presentation with your friends or family, and so that they can learn information about this as well. So we're going to take a couple of questions. Hope you've enjoyed everything. Okay, so let's take a look at the first question. Okay, you mentioned recession. How far away do you think we are from recession? Um, okay, well, you know what? You take a look at it, and in the States, and I primarily use American data, GDP growth last quarter on an annualized basis was 2.6%. Inflation is 7.7. So to answer your question, I think technically we're probably really in a recession already, because if you take 2%, 2.6% growth and net out inflation, we've actually got negative 5% growth net of inflation. So we're already probably having a lot of pressure on the economy that just, on headline numbers, just doesn't come up quite the same. Second question. Okay, so the consumers continue to spend quite a bit of money, and typically that means that we're not headed quite to a recession quite yet. What do I think of that? Well, it's certainly true. Consumer spending remains strong. But if we take a look at the depth of those numbers and see what's made up in that consumer spending, I think it tells a bit of a different story. The staples that you buy, and the staples would be the gas for your car, your groceries. We all know that those are much more expensive than they were a year ago or two, and the spending on those things has gone up quite a bit over the last 2 years. Continues to go up. On the other hand, staples purchases, or I should say discretionary purchases, have gone down. We take a look at those purchases, things that you don't need, maybe you just want, whether it's a new TV or a pool or whatever the case may be, those have gone down quite a bit while people have to do the things that they need to live. So I think that the consumer's already feeling the pinch. I think we've all noticed that when we go to the grocery store or anywhere else, that things are a lot more expensive, and a lot of people don't have the money to buy non-staple items anymore. So that concludes the talk. Thank you very much. Hope you enjoyed it, and look forward to talking to you soon.